To understand how Red Lobster went from a household name to bankruptcy, we need to understand the role of private equity. These firms raise money from investors and borrow heavily to buy companies in what's called a leveraged buyout, or LBO for short. After the company is purchased, the debt is transferred to the company itself, and it must repay the debt using its own cash flows. The company may need to sell its assets, cut costs, and underinvest just to cover this debt. If cash flow drops, the company can go bankrupt, even if it used to be doing well, which is what happened with Red Lobster. In 2014, Golden Gate Capital bought Red Lobster for $2.1 billion. They immediately sold the real estate, which included 500 locations and a sale-leaseback for roughly $1.5 billion. After that, Red Lobster had to pay $200 million annually in rent to operate in buildings it used to own. Private equity also added $375 million in debt to the company's books, which left the chain with massive debt and little flexibility. After a failed endless shrimp promotion caused an $11 million loss to Red Lobster filed for Chapter 11 bankruptcy because it was unable to handle the debt and rent demands. This is how Red Lobster deal played out. The company was bought with borrowed money, loaded with debt, and swapped its real estate assets with rental liabilities. The private equity firm recovered much of its investment early on, while Red Lobster was left struggling under rent and debt it couldn't sustain. Red Lobster emerged from bankruptcy as a smaller privately owned company with new leadership and plan to rebuild, but whether it succeeds now depends on balancing business decisions with long-term stability.